Mr. Chairman, Ranking Member Shelby, and members of the committee, it's a pleasure to be here. I welcome this debate. This is a critically important debate for our country, and I think it's time we get to it. Over the past 2 years, our nation has faced the most severe financial crisis since the Great Depression. Our financial system failed to perform its critical functions. The system magnified risk. Some of the largest institutions in the world failed. The resulting damage across affected the country as a whole, affecting virtually every American. Millions have lost their jobs and their homes. Hundreds and thousands of small businesses have shut down. Students have deferred college and education, and workers have had to shelve their retirement plans. American families are making essential changes in response to this crisis. It's our responsibility to do the same, to make our government work better. And that is why yesterday, President Obama unveiled a sweeping set of regulatory reforms to lay the foundation for a safer, more stable financial system, one that can deliver the benefits of market-driven financial innovation, even as it guards against the dangers of market-driven excesses. Every financial crisis of the last generation has sparked some effort at reform, but past efforts have begun too late, often after the will to act has subsided. We cannot let this happen this time. We may disagree about the details, and we will have to work through these issues. But ordinary Americans have suffered too much. Trust in our financial system has been too shaken, and our economy was brought too close to the brink for us to let this moment pass. In crafting our plan, the administration has sought input from all sources. We consulted extensively with members of Congress, regulators, consumer advocates, business leaders, academics, and the broader public. And we looked at a range of proposals made by a number of bodies, both here in the United States, over the last several months. We considered a full range of options, and we made the judgment that now was the time to pursue the essential reforms, those that address the core causes of the crisis and those that will help prevent or contain future crises. I want to be clear, our plan does not address and does not seek to address every problem in our financial system. That is not our intent, and we do not propose reforms that, while desirable, would not move us towards achieving those core objectives of creating a more stable system and addressing those vulnerabilities that are critical to our capacity to prevent future crises. Now, we've laid out the details of our proposals in public, so I just want to spend a few minutes explaining some of the broad principles that guided our proposals. First, if this crisis has taught us anything, it's that risk to our system can come from almost any quarter. We must be able to look in every corner and across the horizon for dangers, and our system was not able to do that. While many of the firms and markets at the center of the crisis were under some form of federal regulation, that supervision did not prevent the emergence of large concentrations of risk. A patchwork of supervisory responsibility, loopholes that allowed some institutions to shop for the weakest regulator, and the rise of new institutions and instruments that were almost entirely outside the government's supervisory framework left regulators largely blind to emerging dangers. And regulators were ill-equipped to spot system-wide threats because each was assigned to protect the safety and soundness of individual institutions under their watch. None was assigned to look out for the broader system as a whole. That's why we propose establishing a Financial Services Oversight Council to bring together the heads of all the major federal financial regulatory agencies. And this council will help ensure that we fill gaps in the regulatory structure where they exist and where they emerge. It will improve coordination of policy and help us resolve disputes across agencies. And most importantly, it will have the power to gather information from any firm or market to help identify and help the underlying regulators respond to emerging risks. The Council will not have the responsibility for supervising the largest, most complex interconnected institutions, and the reason for that is simple. That is a highly specialized, complicated task. It requires tremendous institutional capacity and organizational accountability. Nor would a council be an appropriate first responder in a financial emergency. You cannot convene a committee to put out a fire. The Federal Reserve is the best positioned to play that role. It already supervises and regulates bank holding companies, including all major U.S. commercial and investment banks. Our plan is to give it a carefully designed, modest amount of additional authority and clearer accountability for the Fed to carry out that mission. But we also take some important authority and responsibilities away from the Federal Reserve. Specifically, we propose removing from the Federal Reserve and other bank regulators oversight responsibility for consumers. Historically, in those agencies, consumer interests were often perceived to be in conflict with the broader mandate of the institutions to protect safety and soundness. That brings me to our second key priority, consolidating protection for consumers and ensuring they understand the risks and rewards associated with products, financial products sold directly to them. Before this crisis, many federal and state regulators had authority to protect consumers, but few viewed it as their primary mission. As abusive practices spread, particularly in the market for subprime and non-traditional mortgages, our regulatory framework proved inadequate. And this lack of oversight led, as the chairman said, led millions of Americans to make bad financial decisions that emerged as a core cause of this crisis. Consumer protection is not just about individuals, but it's also about safeguarding the system as a whole. Now, this committee, the Congress, the administration have already taken important steps to address consumer problems in two key markets, those for credit cards and the beginnings in mortgages. And our view is that those are a sound foundation on which to build on more comprehensive reform. We propose the establishment of a consumer financial protection agency to serve as the primary federal agency looking out for the interests of consumers of credit, savings, payments, and other financial products. This agency will be able to write rules that promote transparency, simplicity, and fairness, including standards for standardized, simple, plain vanilla products that have straightforward pricing. Our third priority is to make sure that reform, while discouraging abuse, encourages financial innovation. The United States remains the world's most vibrant, most flexible economy in large measure because our financial markets create a continuous flow of new products, services, and capital. That makes it easier for the innovator to turn a new idea into a growing company. Our core challenge, though, is to design a system which has a proper balance between innovation and efficiency on the one hand and stability and protection on the other. We did not get that balance right, and that requires substantial reform. We think the best way to keep the system safe for innovation is to have stronger protections against risk with stronger capital buffers, to have greater disclosure so that investors and consumers can make more informed financial decisions, and a system that is better able to evolve as innovation advances and the structure of our financial system changes in the future. Now, I know that some suggest we need to ban or prohibit specific types of financial instruments as too dangerous, and we are proposing to strengthen consumer protections and investor protections and enforcement by, among other things, prohibiting a range of abusive practices, such as paying brokers for pushing consumers into higher-priced loans or penalties for early repayment of mortgages. In general, however, we do not believe you can build a system based on a more stable system based on an approach of banning on a periodic basis individual products because those risks will simply emerge quickly in new forms. Our approach is to let new products develop, but to bring them into a regulatory framework with the necessary safeguards in place. Our tradition of innovation in the financial sector has been central to our prosperity as a country, so our reforms are designed to strengthen our markets by restoring confidence and accountability. Finally, Mr. Chairman, a fourth priority is to address the basic vulnerabilities in our capacity to manage future crises. We came into this crisis without an adequate set of tools to confront and deal with the potential failures of large, complex financial institutions. That left the government with extremely limited choices when faced with the failure of the largest insurance company in the world and some of the world's largest investment banks. And that is why, in addition to addressing the root causes of this crisis, putting in place a better framework for crisis prevention in the future, we have to act to give the government better tools to manage future crises. At the center of this, we propose a new resolution authority modeled on the existing authority of the FDIC to manage the failure of weak thrifts and banks, and that will give us more options in the future that we should have had going into this crisis. This will help reduce moral hazard by allowing the government to resolve failing institutions in ways that impose costs on owners, creditors, and counterparties, making them more vigilant and prudent. Now, we have to also minimize moral hazard created by institutions that emerge with a scale and size that could threaten stability. No one should assume that the government in the future will step in to bail these institutions out if they fail. We will do this by making sure financial firms follow the example of families across the country and build bigger protections, bigger cushions, bigger safeguards as a precaution against bad times. We will require all firms to keep more capital and more liquidity on hand as a greater cushion against future losses and risks, and the biggest, most interconnected firms will be required to keep larger cushions, larger shock absorbers against future shocks. Now, the critical test of our reforms will be whether we make the system strong enough to withstand the stress of future recessions and strong enough to withstand the failure of large institutions in the future. These are our basic objectives. We want to make the system safer for failure, safer for innovation. We can't afford inaction, as both the chairman and the ranking member said. I don't think we can afford a situation where we leave in place vulnerabilities that will sow the seeds for future crisis. So we look forward to working with this committee in the weeks and months ahead to put in place a stronger foundation for a more stable financial system in the future. Thank you very much, Mr. Chairman.
Thank you very much, Mr. Secretary.